If you're using a business line of credit to finance equipment you're going to own for the next 5 years, you may be using the wrong money for the wrong job. And if you're taking a 5-year loan to solve a temporary 30-day cash shortage, you may have the opposite problem. Not all business debt is bad, but the wrong debt structure can quietly suffocate your cash flow. Let me explain. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Business owners often ask me, Us, should I use my line of credit or take out a business loan? My answer starts with another question. What exactly are you borrowing the money for? Because borrowing isn't just about getting approved, it's about matching the financing to the business need. First, understand the difference. Let's simplify it. A business line of credit is generally designed to provide flexible access to funds up to an approved limit. You borrow when needed, repay amounts, and subject to the lender's terms, borrow again. That can make it useful for short-term working capital needs. For example, customers take 60 days to pay, but payroll is due every 2 weeks. Inventory needs to be purchased before the busy season. A temporary cash flow gap develops between paying suppliers and collecting customers. Those are situations where a line of credit may potentially be useful. What about a term loan? A term loan is different. You generally borrow a specified amount and repay it over an agreed period according to the loan terms. That can make term financing more suitable for certain longer-term investments. Equipment, machinery, renovations, business expansion, certain acquisitions. The general principle is try to match the life of the financing with the purpose of the borrowing. Imagine a business owner needs $150,000 of equipment expected to benefit the company for several years. The company has a $200,000 operating line of credit. The owner thinks, perfect, I'll just use the line. The equipment is purchased. Now, $150,000 of the company's $200,000 operating facility is tied up. Then, something happens. A major customer is late paying. Payroll approaches. Suppliers need money. Inventory needs to be purchased. The business goes to its line of credit. But most of the available borrowing capacity has already been consumed by equipment. The company used its short-term financial flexibility to fund a longer-term asset. Now, a profitable business can suddenly have a liquidity problem. Here's the opposite problem. Suppose your business occasionally needs $30,000 for a few weeks because customers pay more slowly than suppliers. You take out a long-term loan every time there's a temporary cash shortage. Now you're potentially turning short-term operating fluctuations into longer-term debt. That's not necessarily the right solution either. Before borrowing, understand the underlying problem. The bigger warning. Here's something I want every business owner to hear. A line of credit should not become life support for an unprofitable business. If you're borrowing every month to pay payroll, pay rent, pay taxes, pay last month's suppliers, and the balance never meaningfully comes down, you may not have a financing problem. You may have a profitability or structural cash flow problem. More debt won't necessarily fix that. It may simply postpone the day you have to confront it. Ask what the debt will produce. Before borrowing $100,000, don't just ask, what's the interest rate? Ask, what will this $100,000 produce for my business? Will it increase capacity, improve productivity, generate additional profitable revenue, reduce operating costs, solve a temporary working capital gap? Or are you simply borrowing because the business keeps running out of money? Those are completely different situations. Don't look only at the monthly payment. Here's another trap. A lender tells you the payment is only $2,500 per month. That sounds manageable, but don't make a financing decision based solely on the payment. Understand the interest rate, whether the rate is fixed or variable, the repayment period, fees, security requirements, personal guarantees, financial covenants, prepayment terms, total borrowing cost, and how the payments affect your cash flow forecast. The cheapest looking loan isn't always the cheapest financing. Good debt should solve a business problem or create economic value, not hide a business problem. That's the distinction. Borrow strategically, not desperately. Practical test. Before taking on new business debt, answer these 4 questions. 1. What exactly am I financing? 2. How long will the business benefit from what I'm buying? 3. What cash flow will repay the debt? 4. What happens if revenue is 20% lower than I'm expecting? That 4th question matters because good financial planning doesn't only model what happens when everything goes right. It considers what happens when things go wrong. At Melbourne Accounting Solutions, we help business owners understand the financial impact of borrowing before they sign the agreement. We can review your cash flow, your profitability, your existing debt, your working capital needs, and the financial impact of the proposed payments. Because your banker determines whether they're prepared to lend you the money, you still need to determine whether your business should borrow it. If you're considering a major business loan, equipment financing, or an operating line of credit, contact Melbourne Accounting Solutions. Let's run the numbers before you sign. CEO question. Look at every loan and line of credit your business currently has and ask yourself, what business purpose is this debt serving today? If you can't clearly answer that question, it's time to review your debt strategy. I'm Everald Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future Canadian business, tax, accounting, and financial insights designed to help you succeed. And if you're considering borrowing for your business, contact Melbourne Accounting Solutions before you sign. Let's review the numbers and make sure the financing supports your business, not controls it. Helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.